Afternoon, welcome to another Market Matters video update. We thought we'd drag James Gerrish in before the end of the year to update some subscribers and our listeners to see where we're at heading into Christmas and what's in store. Well, not quite for 2020. We've got another few weeks to deal with here left in the market. Last week was a busy week. Market dropped 300 points high to low, managed to rebound from there. That's some significant volatility for the early December. Do you see that continuing, and how should we play this?
Yeah, you're not wrong, and it will be 2020 before we know it, Harry. So, it's just around the corner. So, last week we saw the market drop, 4% over the course of the week. Pretty volatile week. I think, one of the major takeaways from last week's trade was around, markets positioning around a trade resolution. I think the market's clearly positioned for a favourable outcome, and then any sign that that favourable outcome isn't happening or there's going to be a delay in it. It was around Trump's comments last week that he was in no rush to do a trade deal. Perhaps that it would be better if he waited till after the election in November of 2020. I don't think that's going to be the case. I think he needs to do a deal before the election. But we saw the big impact on markets that it had. Our market closed down for the week. The US market actually recovered to close up for the week. So I didn't see major concerns in terms of the broader asset classes that we look at. Volatility didn't spike materially, so it went up, but it didn't spike materially. So we didn't see a big blowout in credit spreads, etc. So there wasn't a huge red flag being raised last week. I think it's market volatility as to be expected at this time of the ASX was trading around all-time highs last week. So I think last week was sort of a shorter term phenomenon. I think the market probably rallies from here given the seasonality that plays out into Christmas.
Sure thing. You mentioned Trump and trade there a fair bit. That trade war's been going on for the better part of 3 years now since he's been elected. It seems an awfully long time to be negotiating out there. How much do you sort of play into his tweeting and his sort of volatility in that rhetoric?
Yeah, so it's really hard. I've written a few times this week that he's predictably unpredictable. So hanging your hat too much on what Trump is going to do, I think, is probably an investment strategy that is fraught with danger. If you think about how he plays it out to November of 2020 to get, in his mind, to get re-elected for a second term. You think about he's going to put pressure on interest rates. So the trade tensions that are playing out, the trade tussle, and the longer it goes, probably the more impetus the Federal Reserve has to cut interest rates. So that's his first port of call. He wants the Fed to cut rates as much as possible. He's got 3 rate cuts out of them. The market's now saying he won't get any more. But I think Trump is probably there going, he'd like a couple of more cuts before the election in November of 2020. He then focuses his attention on that trade war. A trade resolution will obviously be positive. He needs to do that for giving enough time for the underlying economy to feel the benefit of it. So improving confidence, improving purchasing intentions, etc., will have a positive economic impact, and he needs that to show through in the figures. And then ultimately he'll go out next year and spend pretty aggressively on domestic issues, increasing the military spend, etc. And hopefully that'll underpin a stock market that's rallying in 2020 for his re-election. So ultimately I think a trade deal will get done. I don't get too caught up in the week-to-week tweets of Trump. I don't think you can from an investment standpoint because you simply don't know what's going to happen in the short term. But I think that's probably the mindset, the plan that I'm working on at this stage.
All right. Well, election year next year, like you say, markets tend to rally into an election year. Before that, we've got Christmas coming. Is Santa going to bring 7,000 for the ASX?
So the Christmas rally is a really much talked about phenomenon in the market. What you generally see, looking at stats, which I've looked at since the post the GFC, you typically get a bit of weakness coming into play in early December. The strength really comes from the midpoint of December, and it really kicks in the gear in the last 7 to 10 days of December. So that's when you really see the market kick in the gear. Last year it was late. So last year the market bottomed on Christmas Eve. 54.10, it bottomed out on Christmas Eve. So it was a really late Christmas rally come last year. So I think you can only go off statistics and probabilities in the market, Harry. So the statistics point to a Christmas rally. It points more to the later end of December as a Christmas period. And I think it's more of a function of a lack of selling. So if you think about fund managers are reasonably light on in terms of their allocation to equities, etc. Cash levels across the market are high. So you don't get a lot of selling in that sort of environment at the back end of or leading into Christmas, and that's what underpins a Christmas rally typically. So I'm hopeful, and we might have seen the start of it at the back end of last week.
Certainly. So in terms of our portfolios at the moment, it's 15% cash in the platinum. There's about 50-50 equities to income securities in the income portfolio. Are you happy with those allocations and sort of sector weights in between them?
Yeah, you've always got to keep tweaking portfolios, and I think the biggest theme that we've got to be conscious of, in the back of this year, but I think more so in 2020, is what interest rates do. So bond yields, if you go back to June of 18, the 3-year bond yield here in Australia was at 2% or above 2%. In June of 19, it was just below 1%. We're just below that at this point in time. So you've had that big tailwind of falling interest rates. Right now we've got interest rates that are sort of we write about looking for a low. So that the underlying support from falling interest rates in this market has gone. So I don't think we can underestimate how important interest rates are for trade in 2020. I think that's going to be a really key thing to drive the markets. If I take a step back and think about the big rout in equities into December low of 18, and then what we've seen throughout this year, it's been a really positive year for equities, but it's all come down to expansion of multiples. So 24th of December 2018, the XJO ASX 200 is trading on 15 times. It's now trading on 19 times, so it's been a big expansion in multiples. That's okay because interest rates have been going lower, but in the last couple of months we've seen interest rates plateau. So for that to continue, or the market to continue to go high, you need one of two things to play out. You need interest rates to continue to fall lower, or you need earnings to go higher to justify those multiples. So overall I think 2020 is going to be a pretty difficult year in terms of what equity markets deliver, because I think we're starting to see an inflection point in interest rates. I think that's the key point. If you look at one thing in 2020 and keep a real close handle on it, it's got to be interest rates.
Certainly, hopefully Trump can sneak one more cut through. You talked about sort of a middle of December low in the markets. We're about, what are we now, the 10th of December, so a few days away from the midpoint of December. Are you looking at buying anything into this week, or is there stocks that we should be looking at?
So just tying in with what we've been saying about interest rates, and the trajectory of interest rates being a really key thing in 2020, I think you need to be positioning or looking to position in the sectors that will benefit from rates probably not going down is probably the first thing, and potentially rates going higher. So we've been writing a lot about resource stocks, for instance. So resources tend to be a net beneficiary of rising rates. So we're looking in that part of the area. I think that's a good part to be in. We saw copper on Friday night have a pretty good session. I think copper's starting to find some form. I think those, we've got Oz Minerals in the portfolio. Sandfire, we've had a lot of questions on of late. It's a really leveraged copper play. It's dirt cheap. They've had some operational issues. The market's not totally convinced those operational issues have been and gone. So they've sort of been underperforming the broader space there. We've had a few questions in the commodity space. Whitehaven Coal, for instance, so they had a downgrade last week. There's a few things that sort of make me cautious on Whitehaven. UBS have been sold 9% of that stock at $3.22. There's another 5% from Farallon to go in the next few weeks. So I think probably that's all a little bit too hard at the moment. So resource stocks, keen on. So want to be increasing our exposure to resource stocks. Western Areas is another one I mentioned in the report this morning. And on the flip side of that, you look at the higher value stocks. So the infrastructure stocks, the things that have had a really strong support from declining bond yields. So I'm not saying go out there and totally remove those from the portfolio, but I think 2020 is going to be a year where you need to be underweight those high value growth companies, those infrastructure bond-like companies, because they're so influenced on interest rates. If you go back to 2017, where interest rates sort of paused, the decline in interest rates paused, those sort of stocks and sectors, they sort of treaded water for the year. So I think that's what we're positioning for in 2020. So resources stocks, the inflation trade, banks are on the nose at the moment, but I still think that 2020 will be a year where banks will do better than they did in 2019. I know that's not saying much. They had a tough year, but I still think financials are pretty well positioned to benefit from rising interest rates.
All right, certainly. All right, that's all from us here at Market Matters today. Thanks for joining us.